All right, so in this video, I'm going to talk a little bit about the business cycle and kind of how things typically play out. Recognize that although things sort of generally follow a similar trajectory or path, each circumstance can be a little bit different. So this is more the general idea when you're looking at circumstances, things to watch out for, and generally how things progress typically. So let's take a look at the diagram I have going on here. So this main wavy line here, I'm using to represent GDP and or kind of economic growth. And really, since the economy tends to grow over time, really I should kind of have it waving up and down while trending upward. But for the sake of simplicity, I just had it going sideways to make it a little bit easier. So first, let me kind of draw your attention to this part down here. This is the economic trough. So the economic trough is basically when you hit the bottom of a recession. And then you go into the expansion period, the economy is growing. Then you hit the peak here. So normally this trough to peak period is quite a bit longer historically than the peak to trough. So the diagram might make you think that peak to trough is the same length of time, but the reality is historically peak to trough has typically been a lot shorter than the trough to peak. A good portion of the time over the past few decades, probably that peak to trough period, the recessionary period, when the economy is contracting, that's probably more like a year-ish, give or take, a bit on either side. But generally, it tends to be a bit shorter. Whereas the trough to peak could be significantly longer. So it could be, 3, 4, 5 years, even longer possibly, historically. So let's kind of take a walk through sort of how this tends to play out. So I'm going to start off actually when the economy sort of tips into a recession, and then we'll kind of go from there. So generally, when I have the economy tipping into a recession, a little bit after the economy tips into a recession, unemployment tends to rise after the fact. So unemployment tends to be a lagging indicator. One of the reasons it is a lagging indicator is because the economy sort of needs to get a little bit weaker before companies start engaging in layoffs and things like that. So eventually, after the economy is kind of experiencing some harder periods, a little bit of a downturn maybe, unemployment tends to rise after that. And then sometime a little bit after that, generally, inflation starts to disappear or at least to fall. And the reason for that is inflation is when price levels are rising generally, or another way to put that is too much money chasing too few goods. So if we have a recession kind of setting in here where the economy is contracting, not as much money is going to be chasing goods because people are not going to be buying as much stuff. So that's when the inflation starts to fall. And then you go a little bit further on, and it may not be all that long, and some of this can be pretty compressed. It can wind up being a relatively short window of time here. But basically, what will happen is the Federal Reserve is going to start lowering rates. And generally, what's happening is the Federal Reserve is focusing on inflation. So when inflation starts to come down, the Federal Reserve says, okay, we're worried about the strength of the economy. The inflation is going down. We aren't as worried about the inflation anymore because it is going down. But we are worried about the economy, so we'll go ahead and start lowering the rates. And so when the Federal Reserve starts lowering rates, then generally that means the rate that a person would receive in a money market account, that starts to go down because that's going to start to follow those Federal Reserve rates pretty fast. And so the attractiveness of money markets basically peaks at that point, at least in terms of the interest rate. Then, because the Federal Reserve is lowering rates, generally speaking, this tends to promote the bond market hitting a trough. Now, the Federal Reserve is generally lowering the Fed funds rate, which is a short-term rate. That's not the same thing as a long-term rate, of course, or the rate that applies to all bonds, but it does affect bonds. So generally, what's going to happen is as those short-term rates start coming down, you start to see some effects in the bond market, and the bond market tends to hit more of a trough here and starts improving. When I say the bond market is improving, I'm referring more to the prices because prices and yields go in opposite directions. So when interest rates are going down, prices are going up. So as the Federal Reserve starts lowering those short-term rates, and in light of what's going on in the economy, basically some interest rates start to fall, bond prices start to go up, and so the bond market typically is going to have a trough here and it's going to start improving in terms of price. Now, some point later, that may continue for some time where the Federal Reserve is lowering rates and so forth. Some point later, generally the stock market starts to hit a trough. And the reason why it takes longer for the stock market to hit a trough is because of all of the bad economic news that's going on. the lost earnings, lost profits. So the stock market tends to continue sinking for a while, typically. But eventually, the stock market is going to hit a bottom. And typically, the stock market probably is going to hit a bottom before the economy actually technically hit the bottom. And the reason why the stock market is typically going to hit a bottom before the economy hits the bottom is because stocks are based upon present value of all expected future cash flows. So notice it's the expected future cash flows. So if the economy is stabilized enough that investors are evaluating stocks and they're starting to see glimmers of hope on the horizon. So they're starting to see, well, now the economy may not be great at the moment, but we're starting to see indications that maybe it's not falling as fast, maybe it's stabilizing a little bit more, maybe inflation is coming down, the interest rates are definitely low from what the Federal Reserve has been doing, and there are some positive indicators that kind of suggest that things might start to improve at some point. And if that's the case, then basically what will happen is the stock market will typically hit a bottom before the economy does, because it's based on the expectations about what the economy is going to do. So now keep in mind, when I say the stock market hits a trough, that's not necessarily meaning that every company hits a bottom at that point. As we'll see in subsequent material and subsequent videos that I'll go through, probably different companies are going to respond differently in different ways at different points in time in the economic cycle. And so you'll see some differences. So, but broadly speaking, the stock market as a whole tends to hit a trough, and then sometime thereafter, the economy hits the trough. And so once you hit the economic trough, basically the recession is basically over and the economy starts to improve. Now, that doesn't necessarily mean that the economy improves fast. Okay, so keep in mind again that trough to peak period could be a very long period of time, so much longer than the recession period. And so with that in mind, just because the economy hits a trough does not automatically mean everything's great. There are still a whole bunch of people that don't have jobs. The economy is not growing real fast just yet. And so there are lots of things that would make you think that the economy is not great. Now, after the economy starts to improve, because unemployment is a lagging indicator, unemployment is going to start to decline after the economy has improved typically. All right. And part of that is the economy needs to improve a bit because of the fact that employers are going to need to see some sign of improvement before they start hiring people. So the economy has to improve before they start hiring, and therefore that's going to help with the unemployment. Now, there's also a more nuanced reason here for why unemployment is going to typically be a little sluggish to decline. So for that, let me kind of back up a little bit and talk about unemployment. To count as an unemployed individual, the person has to be actively looking for work, which kind of makes a certain amount of sense. For instance, if you are wildly successful and you accumulate all the money that you need and you decide to retire at age 40, well, that's great, but we shouldn't count you as unemployed. You're of working age, but you don't want a job, right? You left the job, you don't want the job. Like that, you're not unemployed, you're retired, basically, right? You just retired a lot earlier. So what's important for the unemployment statistics is that in order to count as unemployed, you have to be actively looking for work. So what can happen is during a recessionary period, if the recession is bad enough and deep enough, etc., people that lose their jobs can get discouraged and stop looking. And if they stop looking, they no longer count as unemployed because they aren't looking. So when the economy starts to improve, it's possible for the economy to create a fair amount of jobs, but for the unemployment rate to not actually get a lot better, because if the economy is starting to improve and if people are starting to get encouraged again, and if some of those people who had stopped looking start looking again, even though more people are getting jobs and they are leaving unemployment from that calculation, some of those people who had stopped looking and were no longer in the calculation are now back in the calculation. And so from that standpoint, sometimes that unemployment rate might be a little bit sluggish. So one of the things you might look at it and to kind of gauge that at some level is how many jobs are being created. That gives you some context. If a load of jobs are being created, that's a pretty positive sign generally. But it's possible that unemployment might be kind of delayed a little bit due to the previously discouraged unemployed workers. So something to kind of bear in mind there. Unemployment tends to be a lagging indicator. So sometime after that, the economy has been growing and expanding, and as all this growth occurs, people start engaging in more economic activity, which means more money is chasing the goods. And so all that money that the Federal Reserve put into the economy when they lowered rates, all that money is now chasing goods, or is progressively chasing goods. which means inflation starts to rise. And once inflation starts to rise, typically gold will hit a trough somewhere in here. Part of the reason for that is gold tends to be something that people try to pile into in order to stay safe, try to preserve their wealth and all this kind of stuff. Well, the economy is growing really robustly, and things like that. People haven't really been piling all their money into gold for the most part. So gold will hit a trough though, because as inflation starts to creep back into the picture, sometimes people start trying to put their money back into gold and things like that because they're concerned about the inflation. I'll come back to gold here in a minute. So once inflation starts to rise, eventually it starts ticking above the levels that the Federal Reserve thinks are acceptable. And so the Federal Reserve starts raising rates to try to pull money out of the economy in order to combat the inflation, which means money markets start looking progressively more attractive as those short-term rates go up. Money market accounts start getting progressively higher interest rates. That's good. But once interest rates start going up, bond prices start going down. And so that's why the bond market is going to hit a peak here, driven very heavily by what's going on with interest rates. Now, sometime thereafter, the stock market will typically peak. The reason why there'll be a gap here, bond markets can be very much driven by what's going on with interest rates, which are linked obviously to what the Federal Reserve is doing and also to the economy. The stock market is going to be affected by interest rates. So increased interest rates tend to make it harder for companies to make money because it's harder for them to acquire inexpensive capital and things like that. But if the companies have enough robust earnings growth because of this great economic situation here, even if the interest rates are going up, earnings may be growing fast enough to essentially outweigh that effect. And so the stock market can continue to grow. And so the stock market continues to grow, but the Federal Reserve keeps raising because of the inflation. And gradually that starts weighing on the stock market. And eventually at some point, the increased interest rates and things like that, the fact the Federal Reserve is pulling all this money out of the economy, starts slowing the economy down. When they start slowing the economy down a little bit, people start looking around and their expectations of future growth start to shrink. And as a result of their expectations of future growth shrinking, present value of all expected future cash flows goes down. And basically, we're going to have a stock market peak. So it's not uncommon to have a stock market peak before the economy peaks, because people are looking ahead and they're saying, you know what, the economy's not growing as fast as it used to be. Interest rates are going up a whole lot. We've got all this inflation, the Federal Reserve chasing after that, trying to get that under control. We're just kind of seeing that, we're going to have less growth going forward, slower growth, less growth. The economy's not doing as well. It's not growing as robustly. And generally, as a result of all these updated assumptions and whatnot, the stock market, it's a peak, basically. Then you have your economic peak, where the economy actually hits its peak and starts to slide into that recession. Keep in mind, at this point, the bond market peaked a while ago. Stock market also peaked a while ago, but after the bond market typically. So then I start sliding into a recession. Again, that lagging indicator, the unemployment starts to rise and creep back into the situation again. Gold is peaking here, partially because in this context, people tend to run into gold when they're concerned about inflation. And in this context, inflation was rising, right? And so they're concerned about inflation, the economy is shrinking, they're concerned about that. And so people are just running for safety. So it's not uncommon that gold tends to do well in this kind of environment, because basically everybody's running for safety for that. Now, it's worth noting that when people start piling into gold and things like that, because they're trying to preserve their wealth, they have this idea that you can't lose money in gold. It's nonsense. It's nonsense. You can totally lose money in gold. You can lose a lot of money in gold. It just depends on when you buy it. So, and really that's true for any asset. If you overpay for anything, you can lose a whole bunch of money. So from that perspective, something to think about is don't assume that you're just going to preserve your wealth there with something like gold or whatever else. Depends on what you're paying for something and so forth. So as a historical example, if you bought gold near the peak in the late 1980s, I believe, so highest price in the late 1980s, I think it would have been pretty close to around 20 years, I think. Kind of early 2000s, I believe, before the gold would have gotten back to what it was in terms of price. So if you bought at the peak in the, I think it's the late 1980s, I think it would have been close to 20 years before the gold price got back to where it had been. So imagine that being essentially underwater on your investment for, the better part of close to 2 decades. And I don't think that even factors in inflation. If you factor in inflation, then that's even worse, right? So from that standpoint, can you lose money in gold? Absolutely. You can lose money in gold. You can lose money in stocks. You can lose money in bonds. You can lose money in real estate. You can lose money in anything. You need to be paying close attention to what you are paying for what you're getting, and that's going to make a big difference. Okay. All right. So that's the general kind of progression. Each cycle is a little bit different. Sometimes things play out a little bit differently for different cycles, but the general idea tends to kind of sort of rhyme with this scenario, or we can be relatively similar to it. So hopefully this helps you kind of assess what's going on in the economy a little bit and make some better choices. Thank you so much for watching, and have a great day.